This is Nightly Business Report with Sue Herrera and Bill Griffin.
Trick or treat? Stocks were a Halloween trick as the Dow sold off triple digits, but are investors in for a treat for the rest of 2019? Up in smoke, Altria cuts the value of its stake in Juul to the tune of $4.5 billion. So now what? And the forest from the trees, the strategy of investing in the health of forests with the added hope of preventing wildfires. All that and more tonight on Nightly Business Report for this Halloween Thursday, October 31st. Good evening, everyone, and welcome. Bill has the night off. Halloween is a time for creepy things, goblins, ghouls, monsters. Well, today, investors were seeing ghosts of a weakening economy. Soft economic data, particularly manufacturing, spooked the markets, and we'll have more on that in just a minute. And ghosts of failed trade talks. One news report said the Chinese are casting doubt over whether there really can be a long-term trade deal. Kayla Tausche starts us off.
China continues to signal that the U.S. must roll back all tariffs in order to get a long-term or Phase 2 deal. But the White House says that shouldn't hold up Phase 1, where talks are still moving forward. The president tweeting today a new location to sign the deal will be announced soon, and suggesting the deal will include more than half the chapters that have been under discussion. There are a couple summits already on the calendar. President Xi Jinping will be in Brazil in 2 weeks, and both leaders are invited to the World Economic Forum in Davos. But the looming December tariffs are viewed as a deadline. Tomorrow, the principals will speak by phone in a conversation that could yield new details and next steps. For Nightly Business Report, I'm Kayla Tausche in Washington.
Add it all up, and you have a witch's brew. The Dow fell 140 points to 27,046. The Nasdaq dropped 11, and the S&P 500 was off 9. For the month, all the averages were up. The Dow just a fraction, but the Nasdaq added 3.5%, and the S&P 2%. Bob Pisani has more.
October ended with a thud, hurt by more weak manufacturing numbers and a report that China is hesitant to make a long-term trade deal with the United States. But it was actually a pretty strong month overall for the averages, considering we avoided any scary October crashes or major market plunges. S&P 500 sitting right near historic highs. And although the Federal Reserve is taking on a more passive stance on interest rates, the market is still confident enough that the backstop is still there, meaning the Fed is going to step in and cut rates again if it needs to. Trade talks are presumably still on between President Donald Trump and Chinese President Xi Jinping, though the market has lost some faith in the prospects of a long-term deal today. The market is entering its seasonally strongest two-month period of the year. That's important. November is the second best month for the S&P since 1950. December is number one. That's according to the Stock Traders Almanac. The problem is there are still bitter memories of a disastrous December last year, and conviction for a rally from here is remarkably lacking. Trading volumes have been very light in the last couple of weeks because a lot of traders are sitting on the sidelines. Some feel they had good enough returns and maybe would prefer to lock in those returns now rather than chase further advances. And the news flow from the White House on trade is very confusing. So next up is Friday's jobs report, likely taking a hit from the GM strike this month. After that, it's all about trade. Moving all tariffs is probably too optimistic, but there's still some hopes that the December 15th tariff hikes can be put off. What about those bitter memories of last December? There's a key difference here. Last year, everyone was worried the Fed would begin a cycle of rate hikes. That was a big factor in the December drop. That is not a factor this December. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
So what can we expect from the market for the rest of the year? We're joined by Sandeep Bhagat. He's the Chief Investment Officer at Whittier Trust. Welcome. Nice to have you here.
Great to be back.
I see from these notes that you're looking for a continuation of the rally, but a more modest move in the Dow. Is that a correct read?
That is fair. And the biggest development in recent weeks, Sue, is that we have seen a decline in uncertainty and a de-escalation of tensions on so many different fronts. So these come to mind right away. It seems like we will avoid a no-deal Brexit. We seem to be on track for a Phase 1 deal with China by the end of the year. The Fed has clearly communicated where they stand. And most importantly, all those fears about an imminent recession well, they seem to have receded because growth is still coming in above expectations. And so against that backdrop, I think the path of least resistance is still to march on higher, but it'll be a slow grind, maybe 2-3% more to the upside, which is about 800 Dow points and 85 S&P 500 points.
So you're still sticking with your 3125 target on the S&P?
Yes, ma'am. And it is based really on these key views and assumptions. No recession anytime soon, so none in 2020. We should see a modest pickup in growth, both of the economic and of the earnings variety. Why do we say that? It'll be boosted by all the easing that all the central banks have done. That should begin to pay off. We do see some resolution, partial as it may be, on the trade front, and that should spur growth. And then inflation is muted, and that means interest rates will remain low.
So what areas of the market do you think are still fairly valued and perhaps will retain leadership as the market moves higher?
So let's take this all the way from the top, right? So you have the first big stock bond decision to make. Interest rates are extremely low. They're not justified just by the slowdown in growth. I think investors are seeking safety and liquidity in great doses, and they have overpaid for those. So we think actually that the bond market is overvalued. The stock market is fairly and fully valued.
Right.
So that leads us to picking stocks over bonds. Underneath that, we still like the US stock market a lot more than the foreign stock markets. And then if you had to pick sectors, we would take something more cyclical like technology, consumer discretionary and financials over staples and utilities.
On that note, thank you so much, Sandeep. Nice to see you again. Sandeep Bhagat,
Likewise.
Chief Investment Officer at Whittier Trust. A big batch of economic data out today, some good and some bad. Here's a run through. The number of Americans filing for first-time unemployment benefits rose last week as the wildfires in California likely played a key part. Personal income and spending in September rose slightly, and they were in line with estimates. Consumer spending accounts for more than 2/3 of economic activity. It was driven last month by purchases of vehicles and spending on health care. Inflation was muted last month as consumer prices measured by the Personal Consumption Expenditures Index, or PCE, were unchanged. The PCE is the Federal Reserve's preferred measure of inflation. But the big weight on stocks, manufacturing, as the Chicago PMI, which measures manufacturing activity in the Midwest, dropped to its lowest level since December of 2015. So let's turn now to Joe Bosuelas to talk more about what all this means for the overall economy. He is the chief economist at RSM US. Welcome. Nice to see you, Joe.
A good All Hallows Eve to you.
All right, let's start with manufacturing, then I want to broaden it out to the overall economy. You're one who thinks that we've been in a recession in manufacturing for some time now.
That's right, for at least 3 months. The proximate cause is the trade war and the self-inflicted problems at Boeing. You can see it now both in the sentiment data and the hard data. What we saw today in the Chicago PMI was an outsized decline. Now, much of that did have to do with GM. However, there are real problems inside that survey that point directly to that trade war.
So a lot of people, when they see the employment report tomorrow, may write it off because of the GM strike, but you're one who says not quite so fast.
Right. So look, there's going to be a loss of about 50,000 jobs in goods producing and manufacturing, which should suppress the top line. I'm expecting 75,000 net gain in employment. But once we back out the distortion, we'll want to look under the hood to see what's going on in business services, government, education, and health hiring, which has really begun to drive overall hiring. We will see further problems, though, linked to that trade war. Hiring is slowing. By the end of the year, we should see 100,000 per month on average. And by Election Day 2020, it'll be about 50, and the unemployment rate will be going up.
But you do not expect a recession, correct?
No, I don't. It would take a further policy error in trade, i.e. slapping tariffs on all auto imports from the EU and the UK, or a large exogenous shock. All we're doing is slowing back the trend. We're at 1.8% right now. That's fine. First half of next year will be around 1%. Not quite stall speed, but slow enough to cause material discomfort across some portions of the manufacturing sector.
So what external events, or perhaps events that are on your radar, might derail that scenario?
Well, 6 weeks ago, the Iranians took out half of all Saudi oil production. I'm actually surprised that we haven't had more distortion because of that. Should there be further hostilities with Iran in the Middle East, that could be a large enough exogenous shock to tip the economy into recession. But probably the more proximate cause would be an intensification of the trade war, either with China or a new front with Europe.
On that note, Joe Brusuelas, thanks so much.
Thank you.
Joe is with RSMUS. Late last night, Ford and the United Auto Workers Union reached a tentative deal. That agreement comes less than a week after GM workers returned to work following a 40-day strike over a new contract. Once the Ford deal is ratified, the union will turn to Fiat Chrysler. And Fiat Chrysler and the European automaker PSA, which is the parent of Peugeot, are planning a merger. And as Phil LeBeau tells us, the deal, if approved, would create a global auto giant with plenty of advantages and some sizable challenges.
At Fiat Chrysler's U.S. headquarters outside Detroit, it may be time to change the sign again. The parent of classic American brands like Jeep and Ram trucks plans to merge with Paris-based automaker PSA, which sells Peugeot and Citroën, two popular car brands in Europe. It would be a 50-50 merger, creating the world's fourth largest automaker, selling a combined 8.7 million vehicles last year. For PSA, adding Jeep and Ram brands, along with their strong sales in the U.S., is attractive. Meanwhile, Fiat Chrysler would move into a company with the size and scale to afford the massive costs of developing electric vehicles. After reporting better than expected earnings in the third quarter, FCA CEO Mike Manley would not discuss the proposed merger. Instead, he talked about the opportunity to grow sales of electric vehicles, particularly in Europe.
When I look at the pricing in Europe in particular for electrified vehicles, I'm actually much more encouraged now than I was a few months ago, particularly on the full battery electric side.
EV sales will become more important over the next few years as Europe forces automakers to meet lower emission standards. EVs will also be critical to growing sales in China, where Jeep has a limited presence and Peugeot has struggled to break through. If this merger gets approved by the U.S. and French governments, it could lead to more deals among other automakers, as the industry looks to offset the rising cost of developing electric and autonomous vehicles. Phil LeBeau, Nightly Business Report, Chicago.
Coming up, the House is moving ahead with its impeachment inquiry, and that bit of business puts it on a collision course with another crucial one, keeping the government up and running. Tobacco producer Altria's quarterly results beat estimates for its third quarter, but the company took a big write-down or reduction of value of its stake in the e-cigarette maker Juul, taking a $4.5 billion charge against its earnings. As a result, Altria shares fell more than 2% on the day. Frank Holland has more.
As vaping concerns continue to rise, Marlboro maker Altria is lowering the value of its investment in e-cigarette maker Juul. Less than a year after the tobacco giant made a nearly $13 billion investment in Juul for a 35% stake, Altria CEO Howard Willard said on the company's earnings call that investment is now worth 35% less.
While we had a range of scenarios when we made our investment in Juul, we did not anticipate this dramatic a change in the e-vapor category. Certainly the lung injury, I think, was something we had not predicted, and the pretty dramatic potential regulatory change.
Today, the CDC announcing 37 people have died from vaping-related illnesses, 3 more than just last week. The illness numbers also climbing to nearly 1,900, a more than 17% increase. Both the FDA and the CDC continue to investigate the cause of this epidemic as congressional leaders continue to push for a ban on all flavored vaping products.
It's so important that we put this in effect ASAP to prevent more kids from vaping.
Illinois Representative Raja Krishnamurthy is leading the push in Congress and says he and other congressmen sent a letter urging the White House to enact the flavor ban it proposed in September.
It's very disturbing to know that a company would, in the first place, sell such products, and then secondly, continue to do the things that we uncovered in our investigation, such as going into schools, paying high school districts and other schools to basically go in and basically present their products as safer than they are.
The write-down getting mixed reaction from analysts. Owen Bennett from Jefferies says the Juul impairment suggesting money was not wisely invested. Furthermore, with cigarette share continuing to face headwinds, it looks like the outlook will remain pressured. However, Christopher Grove from Stifel wrote, the $4.5 billion write-down in Juul was already contemplated in the stock price, in our view, and likely more. We continue with our buy rating. Altria says it expects profit from 2020 to 2022 to be impacted by issues with Juul, as well as the continued decline in cigarette sales. For Nightly Business Report, Frank Holland.
Dunkin' Brands is betting on its new menu, and that's where we begin tonight's market focus. The restaurant chain topped earnings expectations but fell short on revenue. U.S. sales were helped by strong demand for premium breakfast sandwiches and specialty coffees. Dunkin' raised its full-year guidance as it looks to introduce new menu items, which include Beyond Meat breakfast sandwiches. Shares rose more than 6% to $78.62. Technology hardware company Universal Display's quarterly results beat analysts' expectations. The key supplier for Apple says it saw strength on a global scale and will be raising its revenue guidance. Shares rose more than 15% to $218. Kraft Heinz reported better than expected profits thanks to lower costs. The food company also said it's looking to increase marketing for its flagship brands, whose major products include Heinz ketchup and Velveeta cheese. The shares climbed nearly 13.5% to $32.33. And rolling power blackouts in California helped demand for Generac's generators as the company topped analyst estimates. Generac also raised its guidance. The stock was up more than 4% to $96.58. After the bell, Pinterest missed revenue expectations, but the image-sharing site did see growth in global monthly active users. But that revenue miss sent shares initially down more than 15% after hours. They closed the regular session down about 3% to 25.14. The House passed a resolution formalizing its impeachment inquiry against President Trump. This establishes a roadmap of the process and makes it more public. And while this is going on, the deadline to fund and not shut down the government is rapidly approaching. Elon Mui has more on this collision course.
The atmosphere on Capitol Hill was charged after House Democrats voted to formalize their impeachment investigation into President Trump.
We take no joy in having to move down this road and proceed with the impeachment inquiry, but neither do we shrink from it.
Every single Republican reject this Soviet-style impeachment process.
The next phase of the investigation will include open hearings, possibly with new witnesses. The Intelligence Committee will put together a final report, and then the Judiciary Committee will decide whether to move forward with articles of impeachment. It will be a bitter and partisan fight. But amid all of that, Republicans and Democrats will have to find a way to work together to keep the lights on in Washington and prevent another government shutdown.
We have to fund the government every year. And Congress and the president are always going to find an excuse to kick the can on their deadline. So we have to be able to walk and chew gum at the same time.
There are just 8 working days left in the House before the government runs out of money on November 21st. House Speaker Nancy Pelosi and Senate Majority Leader Mitch McConnell spoke on the phone about this earlier this week. But today, McConnell accused Democrats of playing politics, particularly with funding for the military.
The core message here is hard to miss. Our Democratic colleagues have a priority list. Picking fights with the White House is priority number 1. Number 1. And our men and women in uniform fall somewhat further down.
Democrats say there's no timeline for the impeachment investigation just yet, and they're committed to funding the government. But there's a broad expectation that Congress will have to resort to a stopgap spending measure and kick the can down the road once again. For Nightly Business Report, I'm Elon Mui in Washington.
And politics is at the forefront for social media companies. We told you last night that Twitter said it will ban all political ads from its platform. And as Julia Borston tells us, that stands in stark contrast to Facebook's stance.
At the same moment Facebook released its earnings Wednesday afternoon, Jack Dorsey tweeted that he's banning all political and issue ads from Twitter to stop the spread of misinformation. Tweeting, quote, "A political message earns reach when people decide to follow an account or retweet. Paying for reach removes that decision, forcing highly optimized and targeted political messages on people. We believe this decision should not be compromised by money." Political ads comprise a tiny percent of Twitter's revenue. It generated $3 million from political ads during the 2018 midterm elections. And the company says this does not impact its guidance for the fourth quarter. Fresh on the heels of Dorsey's announcement, Facebook CEO Mark Zuckerberg defended his decision to run political ads on Facebook's platforms and to not fact-check them. Zuckerberg saying in Facebook's earnings call that political ads are key for free speech.
We estimate that these ads from politicians will be less than 0.5% of our revenue next year. So that's not why we're doing this. To put this in perspective, the FTC fine that these same critics said wouldn't be enough to change our incentives was more than 10x bigger than this. So the reality is that we believe deeply that political speech is important, and that's what's driving this.
A lot of reaction in Washington, D.C. to Twitter's new policy, with the Trump campaign blasting the decision, calling it yet another attempt to silence conservatives. Presidential candidate Amy Klobuchar pointing to the lack of consistent policies across social media as evidence of the need for regulation. But Twitter has its defenders, including Hillary Clinton and Congresswoman Alexandria Ocasio-Cortez. They say Dorsey is making the right call. This overshadowing the headlines about Facebook's far better than expected results. It beat expectations across every financial metric, grew users faster than expected, and gave guidance that was better than analyst projections. For Nightly Business Report, I'm Julia Borston in Los Angeles.
Coming up, an investment strategy to help prevent wildfires like the ones in California. In addition to the fires that have been burning, a new blaze has firefighters battling a wind-driven wildfire in San Bernardino, California. The so-called hillside fire has destroyed or damaged 6 homes and 2 outbuildings. 500 homes have been evacuated. It is one of 2 wildfires burning east of Los Angeles. And hotter, drier weather combined with overgrown forests have contributed to the most destructive fires in history in just the past few years. Now there's a new strategy to prevent these fires that has investors piling in. Diana Olick explains in the latest installment of her series on the rising risks to real estate.
As wildfires now rip through thousands of acres of California real estate on the heels of record-setting destruction last year, a unique financial strategy to prevent such fires is underway in nearby Tahoe National Forest. A bond that provides immediate, much-needed funding for fast restoration of the now overly dense, dry, and dangerous forest.
I see a beautiful forest in front of me. What do you see out there?
It is strikingly beautiful. But what we really have right now is an overstocked forest.
Zach Knight is managing partner of the nonprofit Blue Forest Conservation and the brains behind the first-of-its-kind bond.
It's really a public-private partnership where we've engaged investors like pension plans, insurance companies to help cover the upfront costs of doing this much-needed forest restoration work with the primary goal of reducing the risk of catastrophic wildfire.
Here's how it works. Investors buy into the bond, in this case, a $4 million loan held by Blue Forest. It gives the money to contractors who do the forest thinning. Investors are then paid back over 5 years with 4% interest by those who benefit from the work and have contracted with Blue Forest, like the Forest Service, state agencies, and Yuba Water, whose reservoirs receive water from the forest.
There's about 300,000 acres upstream of our reservoir here that our water comes from, and we care about the quality and quantity of that water from the forest.
Willie Whittlesey says it's worth it for Yuba to pay investors back a little more over time because of the invaluable benefit of getting the work done now.
The need for funds is immediate. We have a longer summer season or a shorter wet season, and we have significant north winds that are an effect of climate change. We need to do something now.
Yuba can't rely on funds from the Forest Service anymore because the service is now spending more than half its budget fighting fires, and climate change could push that higher.
It creates this vicious cycle where we're spending all this money to fight fires, and that takes money away from the preventative work that could stop those fires in the first place.
The driving force behind this is an increasingly popular type of investing called ESG, environmental, social, and corporate governance. It's investing for the greater good, in this case, buying into the health of the forest, but still making money.
Our investors are looking for an impact and a financial return, and this is off the charts when you look at what it's giving back.
Jennifer Price says her investors want to align their capital with their values, and fighting the effects of climate change is #1 on their agenda.
It's a little bit harder, I do find, for people to buy into at times, preventing rather than mitigating and taking it away or stopping, but we're preventing it from even happening.
The greatest risk, she says, is if they don't do more bonds like this one.
Because if this transaction isn't replicated or there isn't other funds allocated to do the forest clearing, the forest fires can still rage.
For Nightly Business Report, I'm Diana Olick in Tahoe National Forest.
Before we go, here's another look at the day's final numbers from Wall Street. The Dow fell 140 points, the Nasdaq dropped 11, and the S&P 500 was off 9. For the month, all of the averages were up. And that is Nightly Business Report for tonight. I'm Sue Herrera. Thanks for joining us. Have a great evening. We'll see you tomorrow.